Started. Well, good afternoon, investors. Welcome to our first bull session of the second quarter of 2024. We were talking before we got started about how the first quarter has greatly exceeded the catastrophic expectations of most of the experts from 4 months ago. So I think we can kind of roll around in that reality and look forward to going ahead. My name is Mark Robertson. I am joined here by my dear colleague, the magical mathematician of Mid-Michigan, Ken Kavula.
Hi, everybody. Glad to be with you.
And
glad to have Matt and Kim in our room with us as well.
Absolutely. Matt is joining us from Houston, Kim from Florida, and we are happy to have them along, bringing us sunshine, pre-eclipse sunshine, perhaps. The big eclipse is a week from today, right?
We hope it's scattered thunderstorms is the forecast for Texas Hill Country.
Oh, great!
Which is better than just totally cloudy, which it is on the weekend. But I may be able to put to use my Midwestern storm chasing skills.
Natalie is on a site because she's very interested in this. She's on a site that tells her on a day-to-day basis which cities are in and which cities are out, depending on cloud cover and rain and weather and everything else. So.
All right, so we are here with the four of us to celebrate opening day, and again, a continuation of the marathon of investing. And Ken, I love the Amish. I just want to squelch a question that came across pre-session that you and I have not converted to the Amish following up there in the upper right.
That's because that's a reference that only people of a certain age get anymore. So
I know it.
You guys.
All right.
We have our friends George and Dwight out in the audience, Mark, that are telling you that the eclipse is a week from yesterday, not from today. So folks, don't go out looking for it tonight.
I was rounding off, George. All right, so we are going to take a look at the groundhog. We are a full 2 months into it. It should be calming down and not moving around so much, but it is doing pretty well. We're going to finish off the few moments with the Motley Fools with a look at one of their more successful funds and talk about caps a little bit. We're going to spend just a brief moment with General Electric and what's going on there if you're not aware of it, so you can watch for it in your portfolios. First quarter results, and then I don't think we'll be adding any stocks, but we'll give a Buttonwood update. Anything else, Ken, that you would like to point out at this point?
Well, I just am going to do as much announcing as I possibly can that our venerable stock picking contest that had lasted for over 20 years has finally run its course. We didn't get enough entries this year to make it something that we felt was going to really give us the return for our time. So we appreciate the 10 clubs that sat down and sent us entries, but we were looking for more like 12 to 15 or even 20 before that contest became something that was worth the time that was invested in it. So we're going to take a hiatus for 1 year in the contest and then try again next year to see if we can drum up a little bit more interest in what we're doing. That was a purely Mid-Michigan contest.
Okay.
I did turn away a number of entries from outside of the state, but we were trying to keep it within our chapter, and we're going to put it on the shelf for a year right now.
All right. Well, maybe we encourage those people to also make a groundhog entry next year if they're
that would be a great idea. Right?
Aching for that. All right.
A lot of the entries that you got, Mark, from these 10 people are already in the groundhog contest.
I don't doubt it.
That.
Yeah. Probably threats to win. All right, here's our weekly reminder that Portillo's is not a sponsor of this session, but they should be. And that's not a hot dog.
That's an Italian beef, isn't it?
It certainly is.
Okay.
Here's your standard boilerplate reminder that no investment recommendation is intended. This is entirely about education, demonstration, and simply illustrating the things that we think are important in the realm of investing. We are literally leaning on over 8 decades of witnessed success of a time-honored methodology used by the modern investment club movement to discover opportunities, analyze those opportunities, and figure out whether they fit in a portfolio, and managing that portfolio once they are inserted there and held for as long as it makes sense to do so. If we own something that we're talking about, we'll try to remember to disclose that. And please do your own homework when it comes to uh, doing the analysis of any one of the stocks that are mentioned. Make your own decisions. The roundtable is a few weeks out. The next roundtable will be a special session with the St. Louis chapter. We've done a couple of these in previous Aprils. We look forward to doing that again, being joined by Candace Baker of the St. Louis chapter of volunteers. And again, that's a few weeks out. If you want to be added to the reminder list for that monthly webcast event, send an email to ncavilla1@comcast.net right there by the arrow. Our 2 email addresses are there if you have any questions, and a full slate of opportunities to register for upcoming educational presentations will be on the Manifest homepage later today. You can also find it at the betterinvesting.org Mid-Michigan website also, homepage.
That April date, Mark, is April 30th, the last day of the month.
Cool. Post eclipse.
And we're going to be starting our roundtables, folks, at 8 p.m. going forward. And St. Louis will be the first 8 p.m. start for us. And we're going to keep that time going forward then. We got a lot of very positive comments about the fact that we were going to start a little bit earlier. Our folks in the Eastern time zone really appreciate it so they can get their beauty sleep.
Yeah, and I need all the beauty sleep I can get, so I appreciate it. Yeah, one of the subjects, one of the reasons we've done that in the past, we started at 8 o'clock with St. Louis, and we're just going to stick with that, is it gives us an opportunity to throw a little education out there. One of the things that we'll be looking at that St. Louis session is simply how to win a stock picking contest. And we're going to lean on the track record of the Broad Assets Investment Club. You'll see about them here in a minute. And I think we'll have some fun with that subject. All right, on to our market overview. Ken, you will notice that the farthest bar on the right is locked in and turned dark green.
That's wonderful, Mark. And it's above the trend. So that's a nice thing too.
Yeah, I mean, we're looking still at 9 to 10% type return forecasts. You can see that value line is still at 9.7. That probably comes down with the next issue or the issue after that of value line. Unless the stock market continues to swoon as it is today, then it would go in the other direction. But the projected return on value and the manifest investing average return forecast, they're both in the 9 to 9.5% range. So we've reached
Yeah,
that point.
I'm getting a query, Mark. The value line number changes once a week or has the possibility of changing once a week. The MyPar number changes every single time there's a trading day. So they are a little bit different, and they, of course, cover a different universe of stocks.
Yes.
The value line number covers the 1700 in the value line universe, and the MyPar number covers the, what are we at, about 2200 in the MyPar universe, Mark?
No, actually, it's closer to 2,700.
Wow. Okay, great.
Which I find amazing. And that we have witnessed a little bit of a decline in expectation, a little moderation in many of those extra 1,000 companies. And I did a comprehensive update, fixed a couple gremlins, and that will be at your fingertips again within the next couple of days. But just a general moderating of some hyperventilating that had been going on. So watch for that.
I
And
will let the audience know, Mark, that if you're doing screening right now on Manifest, then If ODFL, one of my favorite companies, Old Dominion Freight Lines, if it's rising to the top of your screens, give it a moment, please. There was a very recent split at the end of last week, and at least as of an hour ago, it wasn't reflected in the data yet. So if it's rising to the top, it's there not for fundamental reasons. It's rising to the top because it split its stock.
And echoing and reinforcing what Ken just said, you always want to reinforce what you're looking at. Do your own homework, trust but verify, and compare multiple sources, etc. Anytime you're doing that sort of thing.
I'll tell you, Mark, my email blew up with two of my clubs that owned the company FleetCor, FLT. They wanted to know what happened to FleetCor, and that's because they didn't take the time to Google and see that FleetCor is now called Corpay, C-O-R-P-A-Y, and it now has a completely new ticker. It went from FLT to CPAY. So same company, same relatively new business model, but a completely different ticker and a completely different name. And Mark has it fixed, and he has it fixed in a really nice way on Manifest, so that when you call up Corpay, he's put in parentheses, formerly FleetCor, so that you know you're not going crazy, okay?
Yeah, I heard from a couple groundhogs that had actually taken a nosedive in the standings, and I fixed all the groundhog portfolios and then obviously any other general purpose portfolios. But in a moment of weakness, Ken, I have to confess that a person called me and said that they had FleetCor and wonder what happened to it. And it was a moment of weakness. I'm sorry, I regret it, but I told them they went bankrupt. And
And did they have a heart attack on the spot, Mark? Okay.
a little bit. They were less amused than I was. So I got to be careful with that. But
Well,
I had
I
just
also
gotten
think
off the phone on the subject, and I was tired. So
I
I
also
just beg
wonder
your
why a
forgiveness.
company goes to all the trouble of renaming itself and giving itself a new ticker. It's just it doesn't make a lot of sense to me, but it probably made sense to whoever was in the C-suite at the time.
They're listening to their management consultants, so whatever. All right, here's a chart that we like to show on kind of a quarterly basis. It's a busy chart. We apologize for that. But what you're basically looking at here, first of all, take a big step back and appreciate the fact, respect the fact that what Value Line does is not dramatically different than what we do or NAIC or Better Investing. We are all have this notion of you can study the income statement and the balance sheet for a company and better understand the company and make a reasonable forecast, a representative forecast of that company. So what you're looking at here is literally the collective results of 1,700 stock selection guides over time. So starting with on the far left, we're basically comparing the forecast of what Value Line had projected 4 years previously to what actually happened 4 years later. So in the case of the most recent quarter looking back 4 years, back in March of 2020, a stack of stock selection guides, 1,700 of them, had a low total return forecast of 15.7. So with the end of March, we basically check in and say, well, what actually happened? Well, 15.7 actually resulted in 25.4, that green area up at the top. So go ahead, Ken. You like this chart?
No,
It's a
oh,
tough chart.
I love the chart, and I think for projecting ahead 3 to 5 years, Value Line does a pretty decent job of telling you, what's going to happen. I guess I want to hold the hands of a couple of people that are looking into the future as far as Value Line's concerned, and see that kind of trough occurring after the most recent quarter there. That trough doesn't necessarily mean that things are going to go bad. Witness a couple of other times when Value Line took a deep slide down, but the actual market didn't slide nearly as much as Value Line suggested it might. So I'm going all the way back to 2012, 13, 14 in that area there, where I see a big slide from the high in 2012, but the green lines didn't quite match that for quite a few years. So it doesn't have to get down as low as Value Line says it's going to, but it certainly is a little bit daunting to see all those sub 5% returns for what's that, 1, 2, 3, 4 quarters right there in a row, isn't it?
Yeah, and that's merely a reflection of this period here. I should probably change colors. It's too close to the other one that's on the page. But anyhow, that period of inflated stock prices, relatively inflated. You can see that the forecasts were actually all the way down here. That's what you're seeing on that next page. So yeah, it's coming from a position of very stimulated stock prices in general. So we'll see. So again, the takeaway from this, and by the way, this chart is used by the Wall Street Journal. They have talked about this a few times with Mark Holbert, and they actually prepared this slide a couple times. So it's appeared in the journal. All right, moving on, just again, kind of a benchmark or just looking at end of quarter results. You can see that our 7 most widely followed companies that manifest by subscribers continue to do pretty well. The Tin Cup demonstration portfolio also has been faring very nicely thanks to installed building products for the most part, Ken and Kim. Thank you. And
You're welcome.
cha-ching. And the investing roundtable is having a little bit of trouble with our second largest holding being down 30% in the last month, and Apple and Google have had their moments. So we have slipped back underneath a 5% number, but we're still in pretty good stead going forward. And again, all of the indices, if you want to invest in those type of market categories, all checking in at that 10 to 11% range. Nothing wrong with that, unless you'd rather actually live as an investor.
Yeah, well, just remind yourself, folks, if you're sitting out there as a new visitor to the bull sessions or to the roundtables, remind yourself that that last column that you're looking at is how many points you've beaten the market by, not the total return, but how many points have you beaten the market by. The total return is in the chart 3 columns in under annualized total return, and those are pretty hefty numbers even for the indexes. Those are pretty decent numbers.
Yep. All right, so pressing on, you know what makes me sad, Ken?
What makes you sad, Mark?
When I can't
I
capture
know a lot of
enough.
them, but we can't talk about it in public, okay?
Well, I wanted to get my name on here, so I was going to squeeze, you know, as much as I could, and the letters got too small, so I had to give
Yeah,
up.
but if you were going to go to the top 130, we couldn't read it then, okay?
All right. What do you see here, sir?
Well, I love the fact that there's 11 clubs on this top 50 list here. And I'm not sure that maybe, Mark, that statistic, we need to start capturing that statistic over in the box on the right there, the number of clubs that are in the top 40 or the top 50, something like that. It shows that our club portfolios just really know what they're doing. Mark has them in bold type on the list, and that's a club, folks, an investment club up there in first place. And again, if you count, there's 11 of them in that top 50. I always count and I make sure that I see at least one of my clubs on that list, and I see 2 of them there right now, so I'm very pleased.
Yeah, good stuff. The Broad Assets is the club that I referenced. They are a 3-time champion. That's why they have 3 stars here. So they had won it twice, and when we were into their 3rd year where they were leading this contest for the group category, and we did an analysis of how are they winning this thing. That's what we're going to talk about in the preamble to the April roundtable on April 30th. So we'll have some fun with that.
I think David Einhorn is the only other person that could even challenge the broad assets as far as doing really well in this particular contest. Obviously, he's a professional, but looks like he has 3 asterisks by his name down in 44th position as well. He's really made a charge from 87th to 44 in 1 week. That's pretty hefty charge.
Yeah, he generally does well when the market gets weird. So let's hope that that doesn't get too carried away. But yeah, David Einhorn is involved with Green Brick Partners, and we keep track of him. And he has been near the top of the celebrity scoreboard for on many instances. He has some equally poor performances too. So
Yeah. I want to shout out to Curtis Sears, also a previous winner, an individual winner of the contest, who's gone from 51st to 22nd in just 1 week. I really am going to go on the website after this performance here and see what Curtis has in his portfolio that's really juicing it right now. But it certainly has made a huge move up the list, and that's not easy to do. So.
I can tell you it's not our dog. What's his number one, Matt?
Shockwave.
Shockwave. So
okay.
you can't be far off this list either, then, right?
No, I am. I have an anchor. I am positive. I'll say it that
way. You got to work on that desolate tone, Matt. Okay. You know.
I do have Shockwave too, though. It is my number one.
Hey, we've all had that desolate tone occasionally.
Oh, absolutely. Investing is a very humbling exercise.
Fortunately, the contest is not my real portfolio. My real portfolio is weighted by probabilities, so it does much better.
Cool. All right. So one of the things that I wanted to point out was I'll take you back to a year ago. There were very few $1 million portfolios a year ago, like maybe 3. So that's the difference that a year makes. And we also wanted to point out that the value line arithmetic average has actually caught the Wilshire 5000. They're within a few dollars of it. So that's been a long time coming since we predicted it. We like to see it happen. All right. Here's a quick look at the Buttonwood portfolio. I don't think we'll spend any time on it today, although I am tempted by a couple of the stocks that we will be covering. Ken is urging us all to think about Visa as a possible accumulation in the future. And it's going pretty well so far for this one. Notice Green Brick Partners has actually surged and done pretty well.
Almost an all-time high, about $1 away.
Yep, it's up there again. Good stuff.
Just wait till the Fed actually does their first rate cut and watch Western Alliance and Green Brick have a fun day.
More fun ahead.
Yeah, well, Diageo is doing quite well with its. People are still stressed, so they're still drinking.
Yeah, if you're not familiar with the company Diageo, Kim presented it or talked about it at a roundtable, and it's simply some of the best adult beverages in the world. Good stuff. All right, so we will continue. I was going to also point out
that par value for United Health Group is going to go take itself a boost after today. The healthcare stocks, especially the insurers, are having a terrible day after the federal government decided that Medicare was not going to get the boost in funding that everybody had anticipated. So UNH is really down, but not down nearly as much as Humana. So 2 stocks to take a look at.
Okay. All right, just a few more moments with the Motley Fool. I had a little bit of fun with them yesterday. They used to be infamous for putting out a hoax or a prank every April Fool's. About 20 years ago, they had a thing with all of the .com stocks back around 20 years ago, and it was emereng.com, and you can see up there. I posted yesterday, and David liked it, and just continue to have fun. They are fun. So what I wanted to do is spend a little bit of time looking at the Motley Fool 100 portfolio, and then take a moment to actually look at this CAPS feature that we have had at Manifest Investing for a very long time. And the text over in the box, we believe this, that one of the most fantastic things about our community, including Manifest Investing or the Better Investing community, is this notion of community as a source of ideas. I think the CAPS has been that. I think it's been generally underutilized for a variety of reasons, but the one thing that I find fascinating, one of the things I find fascinating is we approached them. I went to a meeting with them in 2006, and they were just coming out with this. We established a link between the Manifest Investing database and their database, and that went without a breach or without any interruption of service since 2006. And sure enough, I was thinking about this. So we get our first breach in, what is that, 17 years? 17 years of continuing service. And they have shuffled the deck a little bit, and we're going to have to figure out if we want to restore it. So one of the things I'm interested in is your perspective on this. Perhaps some of us need a reminder about what it is. So we'll take a little bit of a deeper look, but we basically have to make the decision, especially if it costs any money. Do we restore it, or do we simply give it one of Ken's hiatuses? Your thoughts on this, Ken?
Well, I had told you prior to the start of this program, Mark, that I did a lot of work with the CAPS things when Manifest first began. I used it in a lot of different ways. It was always one of the screening criteria that you could use. And I created my own CAPS portfolio. I maintained it. I added to it, deleted from it to keep it current, like you really are supposed to do. But I got a little bit disillusioned with CAPS about 2 or 3 years into the process, because there were so many portfolios that I would access in the CAPS realm where they obviously had been created and then just forgotten, kind of abandoned, left for dead. And when you have too much of that going on in a big database, it can really skew the numbers. I asked Mark if their algorithms for calculating a lot of the performance, if their algorithms have figured out a way to filter out those dead portfolios. And Mark thinks there really have been ways that they're doing that. And if in fact we're looking at numbers from portfolios that people are paying attention to, then I think CAPS can be an extremely useful tool.
Yeah, and I will confess I have not actively used it. So what I wanted to do is just remind, and then basically reach out to all of you out there. You can either send me an email or post it on the forum. Has it ever led you to an interesting discovery? What's your general perspective? So we'll just do a quick reminder and ask that question, and kind of take it from there, because it really does rhyme with that which we believe and what we try to do in terms of this powerful community of ideas. And so we'll go with that. But first, let's take a quick look at, this is the most recent end of quarter. It's the fund manifest ranked by, as Ken was just pointing out, how much do they beat the market by? Again, this is a trailing 10-year period for most of the funds that are shown here. These are funds, ETFs, and that sort of thing. And this is a database of over 800 funds. So you are looking at the top 20. And you can notice that there's that 5% range number. If you ever wonder how many funds actually beat the market by 5%, well, there's your answer. 12 out of nearly 900 equity-based funds. So small number actually achieved that, beating the market by 5%. But again, we use this as a source of ideas. I really like to put this up and point out, when it comes to building a portfolio, how important growth obviously is. It just sings to me. Am I allowed to be sung to, Ken? I mean,
I think so.
Growth is
So
important.
yeah, just don't bring a Sound of Music into the picture again, okay?
Oh, I'm revving that up for a future session here.
All right.
So these guys do check in at 17th. They've not been around the full 10 years, but I think you'll discover as you dig in deeper, they definitely invest much like us with just a tiny bit more rule breaking and um, non-core type companies, but there's a lot of core companies in there. And let's dig in a little bit deeper into this Motley Fool 100.
Yeah, I'll just repeat, Mark, that when you see the word growth in manifest, almost all of the time we're speaking about sales growth, not earnings growth, but sales growth.
Right, top
So
line growth.
it's very important that you understand that this is something that most of the companies have. I'd like to see that top line growth all the way transferred down to the bottom line and have some bottom line, or have bottom line, let alone have bottom line growth. But it is sales growth, not anything else.
Okay, so let's take a look at the Motley Fool. Here's a look in dollars over pretty much their entire operating period. And you can see that they have outperformed the benchmarks. I don't remember what the benchmarks are, but probably the Wilshire or it's a large growth companies in general. But you'll find that the Motley Fool 100 is pretty chock full of what we would consider to be large companies and medium-sized companies. All right, so here's a look at the top 25. And it
Yeah, there's
actually,
actually a third line on that graph, Mark. It's very difficult for me to see on my screen, but that third line shows how well it does against a peer group, a category, a type
yeah,
of investment. That orangish kind of line, very difficult to see, but it's really whacking them pretty good.
yeah, and this category has done very well over this time frame. That's large growth companies.
Yeah.
So they've outdistanced that by a pretty good measure. So here's a look at their actual holdings. Top 25 holdings representing 80% of their total assets. So it's not an insignificant sampling. As Ken said, these figures here are the top line growth for the individual companies. And you can see the characteristics spread across the page. Again, an average financial strength of 92, earning stability of 74, quality of 90. They definitely are shopping at least in a realm comparable to what we do from top to bottom. I own many of those companies. Let me count: Microsoft, Apple, Nvidia, Google, Amazon. I do not own Meta. We did not go back. I do not own any Berkshire, but let's see, a little bit of Tesla. So probably 10-ish. How about you, Ken?
Well, if I count what my clubs are doing, I think I counted 13, but that includes club portfolios where you have a relatively small position. In my own personal IRAs and my one taxable portfolio, I own 11 of these on the list, and I only own a total of about 18 or 19 companies in all three of those portfolios, the two IRAs and the taxable accounts. So I think that if you're looking at this list and you can't say that you own a half dozen or more, that probably your portfolio isn't doing as well as you might anticipate it's doing. I'm looking at the last two columns, Mark, and I'm amazed at the consistency of par to prove. I mean, there are a couple of exceptions on the list, but for the most part, those two numbers are really tracking together. And what that's doing is that's par proving that prove is a good measure, and prove proving that par is a good measure. They're pointing at each other and they're saying we kind of agree with each other. You've done a nice analysis, So and again, there's a few exceptions, but when you have an exception that leads you to maybe rethink. You can't really rethink the prove numbers. They're pretty cut and dry, but the par numbers are based on things where you have judgments involved, and you might rethink some of those judgments. I'm looking at CRM. That's Salesforce, isn't it, Mark?
Yep, and we're going to take a closer look at that one and see how we might
Yeah,
come to a different conclusion on that one.
yeah,
But yeah,
that's a a considerable difference. There's a couple of others on the list that you might be drawn to and say to yourself, well, maybe we have to take a little bit deeper dive, but for the most part, those numbers track very nicely with each other.
All right. So again, if you've been around and you've seen us do this type of stuff, you already know that we used this list as a source of ideas. And we're just generally looking over the shoulders of people who have demonstrated an ability to find and invest in the type of companies that we are generally interested in. It's that simple. And in this case, we asked the question, what has the Motley Fool been buying lately? That is represented on this screen. This is an output from Y charts. And you're basically looking at, well, what have they actually accumulated in that 100 stock portfolio lately? And the ones up at the top, I mean, we have talked a lot about Google. We've talked about Advanced Micro, Netflix as something that merits attention, all the way down to the bottom of that list. Anything at the top of this list could be worthy of a little bit deeper dive.
I'm certainly impressed by the confidence they're showing in some of the big guys, Mark. I know that an SSG on Microsoft, because it's going to be one of the examples I use in the classes next week. But I know that that the SSG on Microsoft is not suggesting, to me at least, that it's a company I want to accumulate. But the Motley Fool is plunging right in. It's all, it's 12% of the portfolio, and they've added a significant amount to that portfolio. This isn't a little bidly like Coupang up there, third on the list, where the total weight's only 0.13%. So moving it 2.3% is pretty simple. But this is a big holding, more than 10% of the portfolio, and they're moving it almost a full percent. That's a considerable change in the holding. So I'm drawn to things like that on this list, where they're showing a lot of confidence in stocks that maybe I would not have been as confident about before I looked at this list.
Yeah, I certainly wouldn't be afraid to run a stock study on virtually anything on this list, and good stuff. So what I thought we would do is take a quick look at Salesforce. That was the one that had a little bit bigger difference. Again, fairly early stage, but what I think it is, the biggest thing I would like the audience to take away is looking at the sales graphic here. And you notice that the value line long-term forecast is way off the trend. This is an example of a company that is still relatively early stage. These are those moments in time when Ken loses interest in companies, and he's not alone. I mean, they basically hovered near zero for earnings for quite some time. Maybe they have matured to the point where they are out to stay. One of the reasons that we look at operating margin for a company is it can often give clues about where a company is in its company life cycle. And what we kind of see here, in my opinion, is a company that has reached a plateau or a mesa. They seem to like operating in that 30% operating margin area. That would suggest that it is feasible for them to check in somewhere in this range going forward. So, have they reached the point where, and here's the other one, here's the earnings down here. Have they reached the point where it's reasonable to expect something slightly north of what's on the chart? And it's a question that only you can answer. I think that the company has matured. They are definitely leveraged. I would say the majority of Fortune 500 companies are now using CRM, Salesforce, in what they do. So it's worth noting.
Salesforce is a Dow 30 stock, isn't it, Mark?
It is. And in fact, it's on the next slide.
I think it was an odd choice to add to the Dow 30, a stock that had not been consistently profitable for quite a while. So there's some people with a lot of knowledge that have decided this is a comer. It's a stock you need to take a look at.
Yeah, and their acquisition of Slack back in this time frame was not greeted warmly, and I'm sugarcoating. The stock price took that dive down. It actually got down to 133. That wasn't that long ago, folks, and it's doubled from that. So, it has been slightly erratic. Is it going to stay there? Another sign of maturity and perhaps stability is they're paying dividends. They're going to begin paying dividends. And that, again, that's just a sign that they may be achieving some level of stability. So, again, what I wanted to draw the audience's attention to is I think Value Line is probably being pessimistic here. Many better investing people or manifest investing analysts would also be very conservative and perhaps would end up there. Notice that Morningstar also believes that the company is fully valued at 100% price to fair value. But look at the analyst consensus, a much bigger group of people. They are notoriously optimistic, of course, but they think the company is a screaming buy. So again, this is it. You have different opinions out there. That's what makes a market. But what we see happening here is based on these numbers. It is not unusual to end up with a 6.8. You could end up with a par in mid to high single digits also. This company's in pretty good shape. By the way, they have more cash. They have 14 billion in the checkbook than long-term debt. That's always something that gets the attention of many people in our audience. So Ken and I have scratched our head over, what does this company actually do, and how good are they at it? I think they're kind of winning the competitive foray. Anything else here, sir?
No, I think we flagged it pretty well and flogged it pretty well. It's not the kind of stock that I would enter into at the moment, but I think it's certainly an interesting stock, given that it's in this huge index that is rightly or wrongly so widely followed. You always hear about the Dow, and you have all kinds of people that think the Dow represents the entire market, and that means that there's always a market for the stocks that are in the Dow because of this indexing that goes on so frequently. With all that being said, this might very well just be an emerging kind of a company, and if that's so, we've seen how lucrative they can be in the long term.
Yeah, and that's kind of goes back to last week's session with David Gardner and the rule breakers. And I'm sure at some point, somewhere in this time frame, somebody said that it was grossly overvalued, and people pointed out that NMF was the PE ratio. That scares most of us off. So whatever works. And again, here's our reminder that you just have to take that risk sometimes, and it's prudent to do it with a suitable size portion of your club or personal portfolios, because you will, you do this enough for long enough, you will experience this for sure. All right, so let's switch to caps. Again, repeating that message of the power of a community. This is actually David Gardner's page. You can see he's a pretty good investor. I'm only at 80, Ken. I don't know. I haven't done it in a long time, but I'm down around 80, so I'm still among the all-star investors, but I have slipped back. The other thing I wanted to point out here, especially with Matt in the audience, is David is operating right at the Tillinghast threshold of 55% right. I think that's
another
kind of
data
interesting.
point.
Yep, another data point. In fact, we used the caps to get that data point, or to double check that data point. And what I find fascinating is he's actually taken a couple years off, and this is one of his babies, so I don't feel so bad about neglecting it myself. But lo and behold, this is only 2 weeks old, and it's a company that had kind of caught my attention because, if Warren Buffett can buy Fruit of the Loom, maybe there is money to be made in underwear. It's just kind
Also,
of
relative to his quote, the page before, look at his all-time best versus all-time worst. There's a couple more decimal places on there.
Oh, on this page?
Yeah, in his profile.
Oh yeah, NVIDIA. And many of us were
robots that way.
iRobot. Interesting stuff. So let's take a look at Hanesbrands just real quickly. Kind of caught my attention as a company that may be recovering a little while back. I was thinking of it as perhaps an acquisition target, but you can see that they've been in the doldrums for quite some time. I find it interesting that the current price at around 550 is not even back to these levels yet, where it had really gone in the toilet. It has tried to climb out of the toilet here in the last few months, and it could get more interesting. So here's just a quick look at the company. And this is the infamous hockey stick proposal that you may have witnessed at an investment club meeting. One of my rules is to never invest in a company when it's in the middle of doing this, declining quality. So we have to, in order to invest in this, I would have to begin to have some faith that this was going to go back in the other direction, or at least stabilize, hopefully in the other direction. But here's the hockey stick I'm referring to. You basically set history aside. They laid Michael Jordan off back in here some time frame, so that explains some of this stuff. But is it a changed company? Is it possible that that is a representative look at the company? That's the question being asked. I mean, they kind of kitchen sinked it in 2023. Will they climb out? Will they restore the company to these levels with their new strategy and initiatives? What can be expected? Can they actually trek back somewhere between 5 and 10% net margin? Is that feasible longer term? So again, lots of questions. You can see Value Line says no, with a minus 8% projected return. However, Morningstar thinks it's the steal of a lifetime, and the analyst consensus likes it also. So I find it interesting that it triggered attention from David Gardner, and all of these names up here in their product description, their business description, are well known to most of us. And I don't know. It's one that I definitely want to keep on the radar screen. If not, maybe I'll do the Len Douglas thing and buy a couple shares every week for the next few weeks and keep it high on the radar. So Ken, do you ever invest like this?
No. I'm a terrible speculator. I've said that so many times on Bull Session that I'm tired of saying it. And to me, this is a speculative stock market.
Oh, it is.
I stick 95% or more to my up, straight, and parallel. When I do speculate, it makes me so nervous. I jump out way too early a lot of times. So
I know a lot of it comes down to, is there new management? Is there a point where you can actually draw in new management, new strategy? And I don't know. We see in our visits with investment clubs, you and I have both seen this, especially the all male clubs, they're generally more willing to go out on this limb than the all lady clubs. That's kind of the thing, one of the distinguishing characteristics. I don't know. So just toss it out there. I find it interesting that that David has shown an interest in the company. I will tell you that, when I first started looking at this company, I'm guessing somewhere around here. I asked the question, how low can it go? So that's generally, now if I could have
kiss of death.
I could have guaranteed that outcome if I bought some. Anyhow. Any thoughts?
Well, you got all those crosses going on in those moving averages too, Mark. I know that they all have names, and I can't remember which name goes with which cross, but like I got 3 crosses going on here in 10 years. So,
well, the one that Len Douglas will talk about is anytime this red line crosses through the blue line, it's referred to as a death cross. And you notice that it's actually happened a couple of times, and that kind of falls into what I speculate or theorize as the self-fulfilling prophecy at some point, because all of those AI robots out there and trading computers and algorithms, they know about the death cross, and basically it means that the stock price is going to be under some pressure for some time. So
let's see if we get some clarity on underwear from Steve Emmerich. Steve, I'm going to unmute you. You have to unmute yourself, Steve. Go ahead.
I don't know about clarity or not, but Haynes is running a new ad with the saloon, cowboys going into a saloon, and pretty soon they're down to their underwear. And talk about down to underwear, Haynes is down 10.6% in today's trading.
Ooh, opportunity.
I owned Haynes for a long time, and my underwear kept going down, and then they quit paying dividends. So
You gotta rephrase that sentence, Steve.
yes.
Oh, we can't get that image out. Yeah, I did notice the commercials playing during the basketball tournament, and that they are actually getting kind of rave reviews on it. So I'm not sure what to think about that, but
Marketing department is doing their part. We don't know about the rest of it. We'll see when
yeah,
they get earnings.
yeah, it'll be interesting to watch, and it's been on the radar screen for me for a while, but it'll be interesting to see going forward. All right, so the other aspect of caps that I wanted to kick around is just a reminder that you can actually use the caps statistics on manifest investing. With the disclaimer, I'm not sure how much longer this is going to continue to work because it will unravel on the database end unless we intervene. But again, I like I call this the 2% solution, the top 2%. So the manifest rank of 98, your reminder, rank is the combination of these two, equally weighted basically into an index. So we talk about the top 2% with respect to quality and the return forecast, and then the top 2% with respect to the all-star investors, the people who have a demonstrated track record over at the Motley Fool Caps. And it generates this list. I find this list quite consistent with our appetite. Am I wrong, Ken?
No, not at all. There's Iradimed right there, 5 or 6 stocks down the list. Globus Medical that we've talked about recently, United Health. I think MP Materials we've talked about in the last 6 months a number of times. Axos. So there's certainly interesting companies on the list. I, I actually own a couple of them. I'm kind of surprised. So.
Well, the one thing I notice is the community that is here includes some trading-ish, and speculation-ish type stuff. So they're not afraid of the 30s, the 30 PEs. So you're going to see some of those there. But I don't know, from top to bottom, I am fascinated. Ken, I was just going to turn in Yum China as one of my picks for your stock picking contest. So now I have to put that on hold. But I think it does generate a fairly compelling list for further study. So I don't know. I also found, again, I'm thinking coming at this from 35,000 feet. Some people say, well, they don't invest like us. There's some traders in there. Some of those people are just flat out weird. Well, welcome to the market. These people are out there, and by the way, they get to vote also.
And Mark,
So
I want to, people that are saying that, I want to direct their attention to the Better Investing Sentiment tab on the SSG. And notice how many SSGs are disqualified as being just too far out in left field to be counted in the total sentiment numbers. So every community has its kooks and nuts, and we should just be thankful that they don't. At the moment, they don't institute a majority of what we're talking about. I wanted to talk about that 30 PE for just a moment. If that growth number of 25% is accurate, then that 30 PE is very, very, I think that's a reasonable PE if this company can achieve 25% growth for the next 5 years.
yeah, Globant's an interesting company. It's another Cognizant, and pretty good track record. I presented at panels, and I believe for roundtable in the past. So yeah, good, clean fun. All right, here's a quick look at General Electric. Again, we put this in the electrification portfolio back in June, to some dismay. I mean, the core of the General Electric company is pretty formidable, and that's why it's there. And that's actually among one of the top performing selections for this portfolio, which we'll check in from time to time. But this has certainly been a refreshing run for those of us that have forgotten to sell our General Electric shares over the years. And it was always my dad's first question when I walked through the door, anytime I went visiting. So good stuff. I mean, this portfolio has some very promising companies in it, and good stuff. But for now, this is just a quick reminder that this has finally come fully into place, I believe just today. The pieces of General Electric are now 3 pieces. So you don't want to make the mistake when you're thinking about how well General Electric has done. This is actually from a personal portfolio that I'd almost forgotten about until I went looking for this. I wanted to actually make the point that you cannot judge the performance of General Electric solely on the original position here, which is checking in right here. You got to remember that it is now split up into 3 pieces. And we covered this fairly well when they did this one back a few months ago, or actually last year, that the spinoff of GE Healthcare has done very, very well. So again, the perspective on how this company has done over time has to include those 3 fragments or pieces. So just a reminder.
Well, and today's the first day that GEV is actually trading. They had the CEO of the new company, GEV, and the former just plain old GE CEO on Squawk Box this morning, and spent about 35 minutes talking to them. Boy, there's some really interesting things going on in these companies, and the future looks extremely bright for what they've maintained in their portfolio. Remember that they've gotten rid of all kinds of businesses that didn't focus on the healthcare and the aeronautics and space and the jet engines that they've turned into the core of these 3 businesses now.
Yeah, the pieces of General Electric are pretty formidable, and it'll be interesting to see how that continues to unfold. I mean, I was tempted to sell my GE Healthcare spinoff back when it happened, and I resisted doing that. I'm grateful that I did. They are a very respected enterprise in the medical device and healthcare market. So it's just, again, this is just a reminder that you have to look at this as all 3 pieces. General Electric is still, I think, 19th in the most widely followed companies at Manifest, and it's also fairly high up on the Better Investing Top 100. I didn't look it up, but I know that it's up in the ranks and continues to hold a place in our hearts. So we'll cross our fingers and hope for good things going forward.
I just want to remind people that when GE announced this plan to eventually become 3 separate companies, you could pick up pre-split shares of GE, post-split shares of GE. You could pick them up for under $10 a piece. And just understanding that $10 share included a partial share in GE Healthcare and a partial share in whatever they're going to call this new company. I'm not quite sure of the new name yet, but it certainly was a screaming bargain that nobody saw as a screaming bargain when this split off was announced.
Yeah, because you would have had to do one of these type of analysis, Ken.
Yeah.
Well, we did point out when we talked about General Electric a couple times over the last year that you have to look at it as it is not your grandfather's GE. So
well,
we've
except
made
that
that
all
point
my
several times.
shares were my father's GE. So I would never have owned GE at that time, except for sentimental purposes. My dad left me a small holding in GE stock, oh goodness, 30 some odd years ago now. And I just couldn't come to a point of selling it. So I've held on to it, and it's proved to be quite an investment at this particular time. It was quite an investment in the 90s, and it's gone back to some of its glory time again right now, especially when you consider the other 2 stocks that go along with it as part of the original holding.
Yeah, it was one of the largest holdings of the Mutual Club of Detroit. So I was treated to regular sessions on Jack Welch walking on water and everything else back by that crew back in that time frame. And he does walk on water, and he is a fighting Illini, Ken. So
Oh,
got,
well.
got to give him room to run. All
You
right.
know, the other way to think about it besides price, Mark, is way I heard it. I don't know if it was the journal, but the total market cap of these three pieces together is 250 billion. So you think about, you know, when it was the biggest company in the world, and that's not inflation adjusted, was around 300 billion. But it is a remarkable recovery, if you call it that, from the opinion that it was at its bottom.
Yeah, well, I mean, they were 50% a financial institution that had some questionable um, capital decisions out there, and then they also had a pretty big stake in entertainment through the
Well, and
NBC
I think you're
connection.
you're being kind to say that it was only 50% of financial institution, Mark. I think there were years when that percentage inched up closer to 60 than to 50.
Oh, I
So it,
remember.
yeah.
They used to be one of my biggest clients, so I knew them well.
Yeah.
All right. Here's your reminder that we do archive all of these sessions, including the roundtables, bull sessions, and any special educational sessions on YouTube. If you just go to YouTube, search on Manifest Investing, you will find this. If you have trouble doing that, send either of us an email. We'd be happy to help you out. And there's been some fun stuff here. Ken and I don't think we're still on spring break, are we, Ken?
No,
Oh, no.
we're gone from spring break now, and I've
And
burned that T-shirt. So
did Natalie send me to my room after that session, or?
I don't think I've shown this to her yet. So
Yeah. Well, I have reached the age where when somebody sends me to my room, I say thank you and go willingly. So there you go. All right, Ken, you want to go ahead and share what we're going to do in a little over a week?
in a little over a week, we're going to offer 4 classes from the Mid-Michigan chapter. They're absolutely free to anybody that wants to attend. Again, if you can't find a link to register for the classes, send an email directly to nkavula1@comcast.net, and my wife Natalie will send those links directly to you. The first class, Gaining Confidence, is going to be talking about reading an SSG that was prepared by somebody else in your club. How do you go about reading the SSG and coming up with suitable questions that might have to be asked? The underlying question when you read somebody else's SSG is not, do they have the right values? The underlying question should be, is their thought process reasonable? Have they done a reasonable job in preparing this SSG? And if so, then you should be able to trust the conclusion that's coming from that reasonable job. Then we're going to talk about narrowing the field, defining some things that you can use in screeners to focus the screen on certain types of companies that you might need to fill in gaps in your portfolio. It doesn't make sense to me if you're looking for a small company to screen on the entire database. It doesn't make sense that if you're looking for a large company to screen on the entire database. And there are a lot of specifics that you might want to look at that fulfill certain parts of your portfolio. We'll talk a little bit about coming up with screens that will yield 25, 30, 35 great companies. And then we want to be able to take and reduce that screen to 2 or 3 contenders. And we want to be able, using sources that are readily available to each and every one of us, we want to be able to do an analysis of that contenders list without spending 17 hours and without diving so deeply that you forgot the reason that you're doing it in the first place. You're looking for a buy signal or a sell signal, and you're looking for reasons not to buy the stock or reasons to buy the stock. And we'll focus a little bit on that. Mark's done a wonderful job in that with a presentation he made on Gentex. I think it was 2 bull sessions ago. And we're going to pattern our talk about some contenders on that Gentex presentation. And then we'll have a Let's Talk Stock panel. Kim's going to be on our panel. Kim, you got to get the names of those two choices to me in the next couple of days. Mark's going to be on the panel. Likewise, Mark, give me the name of those 2 stocks, okay? I have the name of Ann Manning's 2 stocks from Houston. Thank you, Ann. And Charlene Hansen from Traverse City. I had the name of one of your stocks. Still need one more from you to complete my work on the Let's Talk Stock panel. That'll give you 10 ideas, and we think they're going to be 10 pretty decent ideas for you to maybe use as contenders, or at least as a field that you can narrow down into 1 or 2 that you really want to study. We enjoy doing these classes for you. They'll be April 10th, April 11th, 6 o'clock for the first class, 8 o'clock for the second on April 10th, Eastern Time, and then again 6 o'clock on April 11th and 8 o'clock in the evening for the Let's Talk Stock panel. I've talked a lot about the classes. We're getting wonderful, wonderful registration, and we'd like you to come as well. We think you'll learn something. Even if this is meant for beginners, we think there's always something any investor can pick up from these types of presentations. Thanks, Mark.
All right. So as my provisional first pick, I'm going to bring Haynes Brands.
Okay.
Just kidding. Just kidding.
All right. I was going to jot that down. All right. I don't have to. All right.
Or Yum China, maybe. That one actually could happen. All right.
I better get it in writing, okay?
Yeah. Here's a look at one of our favorite Michigan views that is rarely seen. The view of the Mackinac Bridge from underneath. Just thought it was kind
What's
of
the
a neat
white
picture.
stuff there on the poles?
Ice.
Ice.
Ah,
And Kim can be forgiven for asking that question because she's in Florida.
been a long time since I've been in Michigan seeing that.
Yeah.
Well, this is connecting the lower to the upper peninsula, Kim. So this is cold up there. Okay.
It still is.
It's still freezing up there. Okay.
That water.
Well, you guys may not remember or know this, but I was born in Detroit, and we used to go up to Mackinac Island as, kids with my parents. They take us up there for vacation. But that's like, I won't say how many years.
You ever go swimming in Lake Superior, Kim?
Absolutely.
Okay. Well, you understand what we mean by ice then. Okay.
It's even cold in the summertime. I can attest to that. I can provide visual evidence. All right, just some more resources that are tacked on to the PDF if you pull it up, kind of explaining why we do some of the things that we do. All right, anything else, Ken?
No, I'm ready to call it a night, Mark, and get back to working on my presentations here.
Yeah, I've got a bunch in the hopper also. All right. Well, thanks everybody, and good luck out there. Again, if you have any topics that you would like to suggest for future consideration and exploration, let us know. So for now, everybody, good luck out there.
Mark and Ken, stay on after you sign off a minute.
Okay.